Good morning, everyone, and thank you for joining us once again on this interesting webinar that we are going to have on risk-based capital in Ghana. Reality, the readiness, and then the road ahead. Please stay put, and you're going to have a very, very exciting time to listen to what the insurance regulator has for us when it comes to risk-based capital, what we are seeing in the industry, and what we are also seeing across the African continent and even beyond. And so please stay put and then listen to what we have. And we are doing this with you. And so a time will come, we will open the chat box for you to put in your chat, your question, and also open the mics for you so that you can also unmute yourself and then ask all questions that you want to ask. And so please stay put, stay calm. We are going to give you a lot in this webinar. Before we go on, I'd want to introduce one wonderful person which you all know, in the person of Dr. Kobinasitu, to give us some few messages for the webinar. So Dr. Kobinasitu, please, if you can hear me, we want to see you, and then I'm bringing you your insurance industry.
Okay, Richard, thank you very much. And I think I'm so excited about this particular webinar. You know, we've carried the insurance industry along various journeys, and I think the latest one being the IFRS 17. And we are starting this new journey with them again. And it's going to be an exciting journey because this is a path that we have always wished that Ghana will take this path. And this webinar today, one of the things or one of the key things that I'm so excited about is because we are bringing three people together. The same platform for the people within the industry to hear us and then get it right from the beginning. We are bringing practitioners and auditors together with industry players. Not only that, and we have also been able to pull the regulator to also talk to us about some key things when it comes to the risk-based capital. So I think, Richard, it will be an exciting webinar, and I hope that by the time we finish, all participants will be able to take some key things away from this webinar. But I always say, look, the NIC, that's the National Insurance Commission, has already started rolling out these things on some insurance companies already. So if you've not yet started the journey, I always encourage you to start and start and start. That is why we are bringing this to you from Deloitte. It tells you that we have the resources. It tells you that we have the men to deliver and to assist you on this all important journey. So, Richard, I'm excited and I'm ready to hear from, top-notch speakers. I think you will introduce them very soon. That will bring light to this risk-based capital and how companies can journey through this whole risk-based capital seamlessly, and of course, with the help of the best practitioners, best advisors, best assurance practitioners in town, which is Deloitte. So don't forget to knock at our doors. We will rather knock at your door and pull us in, and we will help you in this journey. So thank you, Richard. Over to you. Thanks.
Thank you very much, Dr. Situ. And I like it when you say that we are best placed to help. Yes. But yeah, people are here to listen to what the risk-based thing is all about. And so we would dive deep into the webinar straight away, and especially given the fact that you don't have a lot of time, but to give a lot to the industry. And so we would first introduce one wonderful person amongst us who is the financial services leader for Deloitte Ghana, in the person of Charlotte Forsin Abbey. She also doubles as an auditor, and she's an audit partner with us here. So Charlotte, if you can hear me and you are here, we want to hear what you have and what your expectations are on this webinar.
Hi, Richard. Good morning and good morning to everyone.
Good morning, Shah.
Thank you for the opportunity.
You're welcome.
Yes, so following from what Dr. Titu mentioned, I think you've also mentioned as well that the NIC is actually piloted this risk-based capital recently. So it's something that is in the works. Kwamina said if you haven't started thinking about this, then please try and be quick because it's already in the works. So, what does this risk-based capital requirement? What does it speak about? What does it entail? So basically, maybe in very basic terms, the NIC is looking forward to insurers, sorry, to start planning towards looking at their capital requirements based on the risks they carry. So if you carry one basket of risks, for example, as an insurance entity, we are expecting that the capital you'll be carrying is also commensurate to that risk, so that at any point in time when you are called upon, you will not be found wanting. That's what basically this is what it's about. So from this webinar, we will know from the NIT perspective what they are looking forward to achieving and the possible timelines, if any, in relation to implementing this risk-based capital. We also know the perspectives from the industry and their readiness. So Kamala mentioned that we brought everyone together, practitioners, the regulator, and all. So we want to know from each other's perspective, what do you expect? What do you want to achieve, regulator? And then for the industry, what are we supposed to do? What do we have to have in our kitty so that we show that we are ready? We have our insurance experts from South Africa to also bring us the perspective across Africa at what the industry should look forward to under the risk-based capital regime. So please, Richard, in short, this is briefly another intro, another perspective. I wish to say that everyone here, please join the webinar and enjoy yourselves. Thank you.
Thank you so much, Charlotte. And from what you have said means that the webinar is going to be loaded because if you have NIC, we have the industry partners, experts, and then even looking at it from the African perspective, it means that we are expecting quite some wonderful time. So,
That's right.
ladies and gentlemen, once again, thank you for joining the webinar. And we are going to listen to the NIC and listen to their perspective on the risk-based capital. And from the NIC perspective, I'm joined by one wonderful person, also known as Kwabena, but this is not Dr. Kwabena Situ, but this is a Kwabena who is a great man at the National Insurance Commission. He is the head of actuarial and analysis at the NIC. He is a commercially minded actuary and a former director at Moody's Analytics. Wow. He's a great man. So, and he has extensive experiences across all insurance solutions and then reserving, etc. When it comes to Solvency II, IFRS 17, transformation, pricing, regulatory reporting, etc. He has wealth of knowledge in that space. And the interesting thing about this gentleman is that he's worked across all the big four firms, from Deloitte, EY, KPMG, wherever you find yourself, Kwabena has been there. He holds a master's degree, degree in actuarial science from from Carr's Business School and a BSc in mathematics with financial mathematics from the University of Manchester. In fact, I could go on and on. He's a UK-based professional, but now has come home to stay with us. And please join me to welcome Kwabena Osei Mensah, who is currently the head of actuarial and analysis at the NIC. So, Kwabena, please, if you can hear from me, can hear my voice, please take over. Let us know what the NIC is looking at when it comes to risk-based capital.
Thank you, Richard. Thank you thank you everyone for inviting me. I think it's an exciting time for the industry, the Ghana industry. I think from our perspective, in terms of the regulator, Ghana is looking to be a hub, an insurance hub. So aligning with global standards is our mantra to be able to attract, I would say, investors, stabilize the market. I think one big thing is risk consciousness on the market. So the risk-based capital is really to drive that. So we have a very stable market, efficient use of capital also within the market to drive growth. And when you have a stable market and confidence breathing in the market, you will have investors come in. Insurance penetration should go up. So, from the NIC's perspective, this is a very exciting time. It sits right at the heart of the Commission's objective, which is to grow the market in surety. So we are here today to help the journey. From our perspective, we have had a touch down with the market. We've had a series of industry working group connects. This happened before my time, but I have seen one also happen during my time. We have gone on to collect data from volunteering companies, and we have had what you will call a mini quantitative impact study in issuing this in coming to this risk-based capital framework. So the industry is very much engaged, and we continue to engage the industry. We're looking at a parallel run for the year of 2025 to be submitted more for Q2, and then we go on to iron out any kind of form of back and forth that will be between the industry and the regulator in preparedness for us to go live with the 2026 year in 2027. So from the timeline perspective, this is what we are looking at. So the industry is going to be engaged, and we are going to be engaged with the industry. We are locked and loaded, and we are hoping that we can all journey on this journey of risk-based capital and compliance together with the industry. Over to you, Richard.
Thank you so much, Kwabena, for making all those remarks. And it's quite exciting because I was making some notes that we are planning for Ghana to become an insurance hub. We're also looking at stabilizing our market, efficient use of capital, etc. But let me ask you, Kwabena, before maybe I introduce other speakers, when we are talking about the whole concept of risk-based capital, from the NIC's perspective, what is it?
Yeah. So, I mean, the fact that we're talking about risk-based capital means the capital wasn't risk-based.
Okay.
It was I would say volumes based. I would say premium is perfect pricing will lead premium to be a measure of risk, but when that's not the case, it isn't. So that if I charge 100 Ghana cedis for 100 cars, premium a contract covering 100 cars, that's what 10,000 Ghana cedis. Another person decides right, I'm going to charge 50 for every one premium, so they cover 200 cars. But you see, if we look at the premiums, they both have 10,000 and 10,000, but the risk is quite different. One is taking on twice as much risk, if you want, than the other. So basing your capital just on that premium volume is flawed. We really want to go down to the risk. And then, so what risk-based capital is really tying capital closely to the risk as much as possible. What does this do? This is going to help us avoid what I call struggling companies running into struggles which is ultimately to protect the policyholder that paid the premium. And so when we do this, what it does also is it brings that risk consciousness all the way to the top, the front line, where contracts are being taken, people begin to think about how that is going to affect their capital rather than just taking the premium. And I think effective risk management really is at the heart of this whole thing. Insurance industry is full of risk. We need to have effective risk management. So I believe the attitude that risk-based capital should steer will be that risk consciousness and the effective management of risk, which will lead to effective use of capital, and hence not throw capital around just like that. So that is what this is. So previously wasn't. Now we're driving towards that.
All right. Okay. Thank you very much, Kwabena. It looks very interesting, and we're looking forward to interesting times ahead. But I have somebody on the call that I need to introduce so that I ask him a very interesting question based on what you have said. So this person is as the head. He doubles as the CFO and then the leader of our actuarial activities, and he's a great man. And he's also the president of the Actuarial Society of Ghana. He's the person of Kofi Intim. Kofi, please, because of time, let me cut everything short, and then please welcome you to the session. And please take this. Based on what the NIC has said, are you ready? Because you are the CFO, you double as an industry person, and you also stand or sit on the seat of the Actuarial Societies of Ghana, for example, and as the president. As the number one, do you think the industry is ready for it, or is it the time we should get into risk-based capital from where you stand?
Thank you, Richard. And I think let me take you back a little bit. In I think 2017 or 2018, the government or NIC brought in an increase in capital, which moved it from I think 15 at a time to 50 million, if you remember. Industry there was big pushback from industry because we felt that it was one size fit all, and that not all companies needed to increase their capital to that amount. The main pushback was that different companies should have a different risk that they would implement. So this is actually good news, where we have risk that matches the capital, that matches the risk that companies are taking on, so that a big company doesn't, a company that maybe writes an endowment doesn't have to have the same capital charges as a company that's just as a pure funeral plan. So this is good news, and it's in a good direction. And so one of there are three things why I am excited, or the ASG and the industry, that we are happy about this new thing that's coming through. And the first thing that I've mentioned is that it aligns capital to risk and raises supervisory clarity. So rather than a blunt normal minimum, the framework is explicit on how qualifying capital resources are measured and capped, how risk charges are aggregated, and how capital adequacy ratios and minimal capital requirements are computed. This would make sure that there's a uniformity across the industry. One key thing that we're also happy about is that, or that we excited about, is that it dovetails into the IFRS 17 and in international practices. We just finished implementing IFRS 17 about 2 years ago in 2023, and so we are now on cash flow estimates, discounting, risk adjustments, and this particular thing also fits into the cash flow methodologies that we have recently implemented. So that makes it easier for us to move into the risk-based solvency, because some of these figures naturally flow through to determine the in the process of determining the RBC that NIC has also implemented. So to answer your question, it's good timing, and industry is excited or waiting for for it to be implemented, and I think it's a good step, and it's in a good direction. Thank you. Over to you, Richard.
Thank you. Thank you very much, Kofi. And that's well noted. But, let me play the role of the normal person who want to undersign insurance. And I understand that, no, you are now going to calculate my risk. And based on that, you are now going to price the products that I want to buy for me, if that's my understanding. Now, what I'm then thinking is that is insurance not going to be much more expensive, and especially given the growth rate? Because at the moment, the knowledge we have is that penetration is hanging around 1%, and it's been 1% for a while now. Have we considered the fact that going RBC will make insurance expensive? I don't know who wants to pick it, maybe, but let me direct it to NIC.
Right. Okay. I think the implementation of the risk-based capital has immediate short-term gains and subsequent long-term gains. I mean, the first question is whether we know whether premiums will go down or will go up in the first place. We don't know. I can tell you from metrics that just because of the lack of risk management in the market, many insurance companies are spending a lot on reinsurance and not utilizing them. So there are levers within the insurance space that this risk-based capital will expose and will cause insurers to rethink some of their risk management frameworks, some of their risk mitigation methods. Without knowing the risk that is on cover or understanding the risk that you are covering, might be very well difficult to say, right, premiums will go up or premiums will go down. But the fact is what I've stated. People are overspending on reinsurance. I can tell you that now. Wow. And so that insight into your risk and the fact that you can understand the extent of what you can handle as an insurance company should then inform the decision all the way through to the underwriting to then help how risk, and what's more, understanding it and managing it well stabilizes the market. We are on global standards. Investors begin to pour in. We are growing the market. Penetration will follow. So these are some of the long term. The short term is tidying up our house, and making sure.
Right. Thank you very much. Interesting times ahead, and I'm so looking forward to when we are actually starting. And I think given that we know the way forward and what we are planning to do, I think it's a better time to look at what is happening elsewhere and what's in Africa or in the world. And so permit me to bring on board our head of actuary who sits in South Africa in the person of Takalani Sikavakawa. Takalani, I hope I got your name right. Please, we want to know from your perspective, and I know you work across Africa. You've been to Ghana, you've been to Nigeria, Kenya, wherever, all places that you've been, and even outside of the continent. What have you seen when it comes to risk-based capital?
Yeah, thanks, Richard, and morning and afternoon, everyone. It's an honor to be here with you. 100% correct, Richard. We have seen a number of African countries adopting or announcing plans to adopt or to implement risk-based capital. So if I can maybe start here where I am in South Africa. In 2018, South Africa adopted SAM, which is a risk-based capital, which is similar to what they have in Europe with Solvency II. We have seen a number of other countries adopting a variant of risk-based capital framework depending on their market. We have seen Kenya adopting their own framework. We have seen also Uganda and other countries in the region adopting a similar framework. If I look in West Africa, last year we saw NICOM announcing plans to implement risk-based capital with the release of the Naira Act. If I look here in Southern Africa, we are seeing Namibia announcing plans to move into a risk-based capital approach as part of the FIMA Act. Zimbabwe, 2 years ago, they also implemented a risk-based capital framework called ZICAP. Zambia, we have seen them also implement a risk-based capital framework 2 years ago. So these moves, as the commissioner from NIC and Kofi indicated, is really to align with the global practices. We have seen movement to RBC is to develop the market. Africa, we have a problem of low insurance penetration ratio. So the risk-based capital will help with confidence, will help in terms of aligning with global practices, improving capital management, improving risk identification, and also risk monitoring and risk management. And that can also help bring investors to invest in our insurance market and to help to grow the market as a whole. Thank you, Richard.
Thank you so much for that perspective. So it means that we are not even behind, and we are also not even ahead of anybody, given that almost looks like almost everybody is getting into risk-based capital around the same time, which is good. And then that brings me to a question, but maybe before Takalani, I come to you, let me go back to the NIC. Kwabena, from the NIC's perspective, I know you mentioned some timelines with some parallel rounds and all that. Would you affirm what are the possible timelines that we are looking at for full implementation of this? You are muted, Kwabena, if you can unmute, please. Yeah, sorry. And whilst Kwabena is unmuting, please, you can continue your question. And
can you hear me?
In the Q&A. Yes, Kwabena, we can hear you loud and clear. Yeah.
Excellent. Thank you. So we sent out a publication on the 5th of February, 2026, which very much brings the directive draft almost to a close. We are waiting for board approval, but if there are any changes at all, very minor. So we just wanted to socialize the directive with the industry, which we did on the 5th of February. Now, what we socialized with the industry, the key milestones, are supposed to produce the 2025 year. The 2025 year returns by the 30th of June 2026. This is the RBC equivalent of what we'd currently have. So what does that mean? It means the 2025 year will be produced on the old and then on the new. The new coming through on the 30th of January. Of June 2026.
Sorry, Kwabena, let me pause you a little bit and to clarify, maybe someone will need more. So you are saying that 2025 year-end final reports still going to be under the old regime, but you expect that entities present a half-year report the
Not the half year. The
or
2025. There's still
so
2025.
they would have to convert the 2025 report into the
Yes.
RBC by the 30th of June,
Yes, please.
2026.
Yes, please.
Thank you
Yeah.
very much. Yeah. So you
Is
can
that
please.
clear? So that's the RBC equivalent, so
Yes.
that you can have a side by side. Now,
Okay.
we have a period of a quarter to iron out,
Okay.
I would say, discussions between the industry and the regulator, so that our analysis submission, so we will do a submission of our analysis by the 30th of September 2026. We are then between that and then November, understanding that everyone is ready to go live for the following year. So the first real submission would be the 31st of March 2027, which is where we've transitioned fully, which means the 2026 year will be on a risk-based capital.
Yeah.
So
Okay.
yeah, so that's what we'll be reviewing your capital based on.
Okay. So technically, it means that for whatever the insurers will be doing by the end of this year, 2026, their submission must be on risk-based capital
Yeah,
because the
fully
financials will
transitioned.
be completed by March 2027. Certainly.
Yes, sir.
All right. Okay, cool. All right. That's an interesting one to know. Now, let me go into the industry. Kofi, please, if you can hear me, do you foresee any challenges with this? And what possible impacts do you look out for? Do you foresee?
I think that the timelines are set. So we just need to work through it. In addition to that, there's been some additional requirement for the actuary to do in terms of new FCR guidelines and new actuarial evaluation timelines. So it's going to be a lot of work and a lot of activities for the various actuarial departments and the finance department. One key thing in terms of challenges is the fact that for the BC, we need to have proper documentation of processes, and that's one key thing that the industry needs to start doing. Make sure that you have well-defined processes. You have you understand how you've defined some of the how you're going to measure some of your risk, and that's extremely tedious. You would also have to get all these documented changes approved by your board. So it would be good to start working early and getting some of these documents ready and passed on to the board for them to take a look at. Also, one key challenge that has visit this industry is data. If for companies that do not have internally run processes, maybe software to be able to do the actual evaluation and then feed it into the SDR template, life is going to be slightly more challenging, because then you would have to ship all data out, but you need to be able to develop internal resources to be able to help with this new regime, because it's a lot of work, and you would need to be able to train resources to take up this challenge. One key challenge that we have in the industry is a lack of actuarial resources. And one thing that we have at the ASG, we've been trying to find ways of helping groom actuaries. And if you would recall, when the IFRS 17 came on board, initially what the actuary did was to calculate the reserve and then give it to the financial team, and then they plug it into their financial statement. And all that changed when IFRS 17 came in. So now the actuary and the financial team work hand in hand. You would see there are times that I'm sitting with the finance team trying to draw T accounts and then seeing credit and debit. And so this collaboration needs to be improved to make sure that we'll be able to meet these timelines. Industry needs to be able to resource the actuarial department and then try and see if they can get more people to take actuarial exams and move along, get more experience to be able to help out with implementing this. Because if you have a one-man actuarial team or you have a very limited financial team, then you would have some challenges. And I think a lot of, as Kwabna Situ said, maybe you'll be knocking on their doors and people would need help because there's a lot of work to be done to be ready for this implementation by here and now it's June, because we have to send 2025 figures out by June, and then also as a dress rehearsal for what is coming next year. So yes, there's a lot of work to be done, but IFRS 17 has helped us, and the implementation has helped us a little bit to get closer to where we want to get to. But there's more work to be done, and hopefully we need to start early. And understand, I know that in the IFRS 17 implementation, we're always waiting and hoping that the timelines would be pushed. But from NIC's posture of late, they might be coming with fines if you don't get your acts together. So I really encourage everyone to start working now, because there's a lot of work to be done.
Kwabna does not look like somebody who like to push deadlines.
Yes, yeah. In fact, indeed, from when I speak to Kwabna, sometimes the way he sounds, he's like, "No, I'm up for it, and this is where I'm going." Kwabna, is that it?
He's a British man.
All right. Maybe let me bring Takalani in, because Takalani, you have gone through risk-based capital implementations at some point. We want to know from our side, what should our industry or our entities be looking out for to ensure they comply? What are some of the things you believe they should do?
Yeah, thanks, Richard, for that. I'm hoping that I'm audible. I think
Yes,
there is a big change. I think the first thing that the industry they need to look at is any guidance from NIC, any framework that NIC produce. We need to follow that. Key areas to look. We need to look at various risk components that the RBC is bringing: underwriting risk, market risk, operational risk. We also need to upgrade our internal risk management processes and controls to ensure that where we have sufficient controls, and that controls can help to reduce the capital requirement, we can use that. We need to stay up to date with any NIC framework, NIC returns, NIC communication. So we need to work closely with NIC. Risk-based capital framework is part of the overall risk-based regime. We need to make sure that the staffs that we work with, the entire insurance company, the entire operations, they are familiar with risk-based capital regime and how they can improve the way we are using capital. So it's important to train staff so that they can understand how they can contribute, what changes do we need to bring into our organization to make sure that as we deploy, as we use capital, we use capital as efficiently as possible. A lot of insurance companies will need support from specialists, support from actuaries interpreting those frameworks, in terms of interpreting the frameworks. Also, actuaries can also advise what do the numbers mean, what companies supposed to do to manage the risk, to manage the capital, and also they can also help with training. They can also help with completing the various return. And also one thing that Kofi mentioned, we just come from implementing IFRS 17, while a number of companies with IFRS 17, things are starting to settle. There's a lot of things that we can leverage from the IFRS 17 implementation. The risk-based capital will be sitting on the IFRS 17 balance sheet. So we need to make sure that whatever we did on the IFRS 17 also talks to what is going to be happening on the risk-based capital calculations. Thanks, Richard.
No, thank you. So it means that from what you have said, it means the insurers need to have a lot to do, let me put it. And given the fact that when you look at the timelines, you are expecting some mid-year report based on the 2025 reports. And from where I sit, I see that even the 2025 reports are also now getting ready. And within the next 3 months after submission, we need to convert that and have to do all these activities that you have mentioned. Then it means that there's a lot of work on the insurance entities. And maybe let me bring Dr. Situ here. Dr. Situ, what role should consultants play, like us? Or are we able to help in any way?
Richard, I like that question. You know, that is the question I was looking for. You know, after helping the industry in the IFRS 17 transition, some of the CEOs were asking me, so what next? What am I going to do next? So, you know, and God has not failed me. There is risk-based capital that is coming. So, Richard, we can do a lot of things for the industry. And I think the time to start is now. And Takalani mentioned some few things. Kofi also mentioned some few things. And I also like what Kofi was saying and repeating that there is a lot of work. There is a lot of work. And thank God it wasn't coming from me, but it was coming from an industry player. So Kofi, thank you for that. First thing we can do is gap and assessment, gap analysis. So we can actually assess the insurance current capital management framework against the regulatory requirements to identify the gaps and areas for improvement. So we can help in doing that. So that is a very key thing that needs to be done. Secondly, we can help to translate the 2025 result into a risk-based capital compliance by the June deadline. So I think that Kwabena said it, that they would like to see how more or less like a risk-based capital equivalent for the 2025, which I think the deadline is June 2026. So this is an immediate one. The gap assessment is also an immediate one that I think we need to engage, or we can engage various insurers and then help them to undertake that. Not only that, when it comes to documentation, you know, the risk processes needs to be updated, right? The risk management processes, policies needs to be updated and submitted to the board for approval. So that we can also do. Then in terms of the internal audit process, which needs to be also re-looked at, we can also help in doing that. Getting the data right. You know, under the IFRS 17, we had a lot of issues when it comes to data. We want to also make sure that this data issue thing is dealt with completely under this risk-based capital. And then obviously, of course, we have been the leaders of trainings. So when it comes to training, we are here to help. And just to also announce that coming August, I think August or September, Deloitte will be having the second round of the actuarial training, which the first round happened last year, which was very impactful. So this time around, the focus will be more on the risk base, although we'll also be doing the IFRS 17, but the focus will also be on the risk base so that we can help the industry to be able to transition to the risk-based smoothly. So, Richard, this and many other things we can help the industry. And please engage, and let us start the conversation. Let us start the discussion. Let us talk. Call me. You know my number. If you don't call me, I will call you because I know all your numbers. I'll start knocking at your doors. So let us start engaging. Start now, and start now. Thank you very much.
Okay, thank you very much, Dr. Situ. I mean, I think I can leave you now, but I would go to the chats box and to pick comments and then chats and questions from there. So please, if you are listening, you can put your chat, your comment. If you want to also unmute to speak to, you are welcome to do so now. But one question that I have, and between NIC and then industry, Kofi and Kwabena, whoever will take it will be preferred. Now, does it mean that you have to look out for a new capital to augment your current or existing capital? Does going risk-based mean that you have to bring in new capital? I don't know, Kwabena, if you want to take that one, or Kofi. Okay. Kwabena, you are muted if you are talking.
Yeah. Hello.
Yes, good. You're audible now.
Right. Does it mean you have to take new capital?
Yeah.
I think we've had something. We've had something before. I want to stress on the fact that risk measurement is key. We've had something. Did that tie to the measurement of the risk? The answer is no. So we will see some on one side of it, and then we'll see on the aggregate when we conducted our test, albeit I think maybe it was on either about 25%, because we had about 14 companies that we had on the balance. We had people, the companies below what it was before, but not to the point that they were insolvent. So I think there's a threshold that we will be checking against. Will it mean that their solvency ratio is lower? Yeah, across the board potentially. But does it mean they drop below the minimum threshold? That will depend not from what we saw, but when the entire market comes in from the parallel run, we'd be able to see. Now, does that call for new capital? Yes, that will mean you need to put up extra. It just goes on to say that you have been taking on a lot of risk with potentially fewer premium over the years, because this won't be something that would have built up only in the 1 year. So the assessment could trigger extra capital, but from where I sit, generally did not look so for all the companies, particularly just for the population that we tested. Yeah.
Thank you. So let me think. Sometimes, and the way sometimes we Ghana, we think here, okay, fine, we're taking off, okay, possibility of upwards. How about someone does the impact assessment and realize that, oh, I'm overcapitalized? Would you allow the person to reduce the capital?
The assessment will be, because we're doing an equivalent of a 1 in 200 year event.
Okay.
I understand. So I mean, the capital charges will be reviewed on an annual basis. Normally, as an insurance company, you should have a policy around what you do with your retained earnings, and also your ultimate capital, such that if there is any profit sharing, or I think that needs to be assessed on the basis of your business plan. Because remember, you will come to your capital after you have finished doing the business, but you're going to also have to hold capital to do business in the future. And so you need to have that consideration in mind, whether you want to grow your risk base. And if you're growing your risk base, then guess what? You shouldn't really be releasing now. You should have a long term thinking around that. And I think this is where Kofi mentioned something about the changes also in the FCR framework, which we are requiring insurers to actually give us a foresight of the 2, 3 year, 5 year plan of how they're going to do business, because that also impacts the capital that you should be holding for your own economic benefit.
All right. Okay. Thank you very much for that insight. So I think I can now go on to my Q&A session. I have think about some 4 questions or 5 now.
I think I was interested to hear what Kofi would say.
Oh, okay, Kofi, let me hear you. Okay, Kofi, let's hear from you first.
No, okay. So I think with respect to whether people need to recapitalize or not, I think that if I were to ask the question, I would ask it as to what would be some of the benefits. So what this would happen is that in terms of it would help insurance companies restructure some of their capital. So, for example, under the new RBC rules, insurers must hold capital not just large in amount, but in quality. So you'd see that there's a tier 1 ultimate unlimited capital, which is mostly equity and retained earnings. So from this, I know that the boards would try to, and the management would try to make sure that they have more of such quality capital that would be would have more of an impact in the RBC. In addition, some of the impacts that this RBC would have would be that in terms of pricing, so it would help people, companies react to having good pricing methodologies, and then it would help the growth of the industry and the company specific. So whilst I don't see a lot of companies having to recapitalize, because if you recall, I said in 2017 or 2018 we had to move to a 50 million capital base. So that already forms the basis. In other jurisdictions, the minimum is probably like $1 million, and then there'll be a RBC on top of that. So I maybe I haven't seen the data as Kwabena would have seen, but I don't expect a lot of companies having to recapitalize, because there is a lot. They have some substantial capitalization from when the 2017-2018 recapitalization. So this process would help them re-engineer, remove, rejig some of the things that they do in terms of how they do business, and that would in all it would help the industry.
All right, now thank you for that submission. But let me jump to Takalani quickly. From where you sit across Africa and wherever you have been, did you see entities have to recapitalize from the RBC perspective? Before I go into the Q&As.
Yeah. Thanks, Richard. So it also depends on how the RBC was brought. So if I look at Nigeria, for example, before RBC came, there was a need to increase minimum capital requirements for insurers. So it was seen as the regulator preparing the industry for risk-based capital regime, to say that have at least an increased minimum capital requirement, so that when risk-based capital regime comes into place, there's no need for you to engage large sum of money into the company, or if you're injecting something, it's not something material. If I look here in South Africa, what happened, the regulator had a number of quantitative impact studies over a few years, I think over 3 years. the first quantitative impact study was not mandatory; it was voluntary. But a lot of companies volunteer to submit to calculate the capital and risk-based framework, and it helped to prepare the industry in terms of what capital are they going to need, and if there are any other levers that the insurers can apply. As Kofi indicated, that sometimes you can bring other risk management frameworks in. You can bring, for example, reinsurance. You can sort of change your asset mix, invest in more in assets that are not very risky, and try to reduce that capital. You can also change your product mix, and start writing more businesses that are less capital intensive. So you can bring a number of risk management processes that can help reduce the capital. So it was a way of preparing the industry, and so that when eventually the risk-based capital gets implemented, the industry has sufficient capitals. Yes, there are some instances where when the RBC gets implemented, some companies will need more capital, and there will be a need for injection from shareholders, or there will be a need for changing in practices. There is also some companies where you find that the risk-based capital is going to be lower than what they were holding. And companies start to think in terms of economic capital, the capital that the company themselves have decided to say, this is what we need based on our understanding of our business, and the internal capital tend to be higher than the regulatory minimum capital. So you will see companies in terms of their capital coverage ratio holding something, for example, 1.5, the minimum capital requirement, so that that is seen as a risk appetite or their internal capital requirement. So you can see both movements, and it's up to companies and their regulators to decide how they want to deal with those. Thank you.
Thank you very much. So it means that the impact assessment is very key for everyone to do, so that you actually know whether you need to recapitalize, or maybe you have to stay or play wherever you are. Thank you so much, Takalani. So to my panel, I have a series of questions here. Please show your faces, and I will direct them to you depending on who I feel to answer. But maybe this question, first one, will have to go to NIC. Kwabena, I'm combining two questions that we have here. So someone said, you mentioned reinsurers are over-insuring. Can you throw more light on that, and how reinsurers position, and how should reinsurers position themselves to take advantage of RBC? And then the second one is also say, I see reinsurance as a mechanism to support insurers cover big risk. That's true or false? And you are also saying that reinsurers are overspending. Insurers are overspending or reinsurance. Can you clarify this for us?
So the first one is insurers.
Mm-hmm.
They said insurers. Yeah. So typically, for every 100 Ghana premium that is written, it's looking like 25 to 30 Ghana goes to reinsurance.
Yeah.
Typically. But you don't have your net loss ratio reducing. If my gross loss ratio is lower than my net loss ratio, then I am not utilizing my reinsurance. Now, if that is consistent over the period, it is quite clear that I do not understand the risk that I am undertaking enough to know the impact of worst case scenarios on my portfolio for me to be able to adequately reinsure myself. So a consistent view of your net loss ratio higher than your gross loss ratio over time means you're giving consistently giving money to the reinsurer company, something that you could have absorbed, not in full, maybe in part. So that is what I mean by spending over reinsuring. Because if I look at the amount of premium paid versus the amount of claims recovered, I don't even see that ratio claims recovered being over 20% from what I'm looking at. What does that mean? That means for every 100 Ghana cedis you pay to the reinsurer, you're only recovering 20. But that's because you don't know what you're covering. So you've shot it in the dark because you are covered. That's basically. But can you understand what you're so reinsurance optimization is something that I believe if the insurers undertake an exercise, if they undertake, they should be able to make some savings from that aspect. So this is what I mean by covering. Yes, someone said reinsurance is to cover from large. No doubt about that. But they are facultative. It's not large across. You can pick the risks that you want to reinsure and not bag them all into one. But this risk identification, this risk monitoring, being able to have a risk register, identify the key risks on your book, and be able to, for lack of better words, maybe I use the technical term, simulate the sort of losses that will come from these key risks. This, when you begin to look closely, you would see that there's a potential for you to be making some savings. So that is what I mean. And the risk-based capital regime or framework is going to make you pay attention to these things. And when you begin to pay attention, then you begin to use your capital effectively, so that there are some risks that you could retain that you didn't know that you could retain, and retaining them could make you more profitable, and be able to increase your capital strength. If so, that is what I meant by over reinsuring and overspending on reinsurance.
Thank you. So I think it boils down to understanding the risk and getting the risk profile clearly so that you know what you can retain and what you can see.
Correct.
Takalani, you were nodding your head. Did you have something to add?
Yes, I agree with Kwabena. I just wanted to say that with reinsurance, a reinsurance company is a company. It's a profit making company. So when a reinsurer when they take on a risk, they take on a risk hoping to make a profit. So it's expected that the reinsurer will make a profit over time. But the benefit of reinsurance should be rather looked over the long term. They help reduce volatility that can happen. So if you look at your combined ratio or loss ratio over a period of 1 year, it might be very, very volatile. But if you look it over a longer period, because of that reinsurance is available, you will be able to reduce that volatility. You will see stability in your loss ratio. So the benefit over time should be great for the insurance companies. But I agree with what Kwabena has been saying.
Okay, thank you very much. So, very interesting one there. So, Kwabena, it looks like most of the questions I have here is going for the regulator because you are the big man in the house.
No. I come
Yeah.
after Kofi.
So, one question. So, I know you have the president here.
Yes.
So, one question says, going risk-based, are the insurance companies going to be grouped into tiers? Are you going to tier insurance companies if they go into risk-based? let's say we are now going to have tier one insurance companies, tier two insurance companies, tier three. Did anything like that cross the mind
there's
of the
nothing
regulator?
like that.
There's nothing like that. Okay,
There's
cool.
nothing like that. Yeah.
Yeah. And another person is asking, any respite for insurers who may fall below the minimum capital after risk-based implementation?
I think we have a risk-based resolution framework.
Yeah, okay.
That is what will I have no comment on
You defer to
the
that one.
respite.
All
Yes.
right. Okay, thank you so much. And then how often should entities submit their risk-based capital calculations to the NIC? Is it going to be annually, quarterly, or half year?
It's a very good question.
Yeah.
I think we've not altered the annual. I think there will be more monitoring, a bit more monitoring. The reason being, like the IFRS 17 that's being implemented, I believe we still have some wrinkles to straighten out. And so yeah, there will be a bit more monitoring until we all very, very stable in what we're doing. No discussions so far on regular requirements, but I won't rule that out as yet. Yeah.
All right. Okay. Thank you very much. So this one question goes to maybe myself and then okay. I think there are questions to the ASG and the NIC. They are saying the timelines you have given are very, very tight, given that resources, people's systems need to be touched, etc. Any consideration in there? And especially, the entities are going to report maybe end of this month here in Ghana, March, and you are giving them, let's say, 2 months to translate the March financials into risk base and submit, or let's say max 3 months here. They are saying it's too tight. What do you have to say to that?
If he's looking at me. Right. Okay. So first and foremost, I don't think the risk-based capital is something that has been heard in the market today or just this year. And the whole of last year, there were drums in for volunteers to come in for the quantitative impact. It wasn't mandatory; it was voluntarily, but certainly the market has been in the know. This is not sprung forth, so that's what I would say. Secondly, the production of the capital for this year, as you said, finishes in the end of March. But the FCR, we have pushed the FCR deadline a little bit further to allow for the production of that report. The FCR, the way it's being framed, should also dovetail into the risk-based submission. And this was shared from the 5th of February. So it's not, again, because one is looking at, we finished producing and then we have 2 months to turn around. No, actually, you should have considered it all the way through. IFRS 17 has been implemented. And just as Kofi said, there's been a bit more granularity to the way data is being looked at. Of course, some are still behind this curve. But you'll always have situations where some we try as much as possible to bring everyone along. I'd say we should all grow together in this compliance. If we don't do it now, when? The insurance market and the globe is moving forward. You heard Takalani talk about many countries in Africa adopting risk-based capital. When should Ghana go? This is the time. So it is going to be a pain. but we push through that pain together. Is what I'd say.
Yeah, we need to start at some point. We need to start something. All right. Thank you so much, Kwabena. So then this next question, Kwabena, your name was specifically mentioned, so please permit me. Does Ghana's RBC model include a qualitative assessment? In other words, if a company has, for example, a bad management, unfit processes, complex process operations, are they forced to hold more capital? That's one. And he said, I ask this because I think what I hear mostly on the RBC is underwriting risk. Any given how business operations and given how business operations are becoming sophisticated, I think operational risk should be a high priority, just as in Solvency II. What do you think? So here, the person is juxtaposing between risk-based and then operational risk to hold capital.
But there is operational risk in
Yeah. Mm-hmm.
There is operational risk in the risk-based capital. So it is a capital charge in there. There is a capital charge in there. Now the question is the assessment of that. I can understand where the assessment of that, as in what is the likelihood of don't know, running, just as you said, bad management, running into regulatory fines, running into I don't know, maybe even cyber risk is one key thing right now. We have to grow in that space, is what I would say. We have to grow in that space. You know, the person asking this question, you're realizing that even the basic risk charges, the market is complaining right now. So what I say is we've rolled this out. This is not going to be the end. This is the start. And so to have those effective measurement processes within to then have to effectively have the correct risk charge is something that we're going to closely monitor. So to answer that question, we have operational risk charge in, but is the assessment what's it called, the cutting edge? I would say we have to see with experience and adjustments over time.
All right, thank you, Takalani. Any remarks from you on that one?
Yeah, thanks, Kwabena and Richard. Yeah, operational risk is one of those that is very difficult to measure. It's very so from what I've seen in South Africa, for example, it's linked to the size of the premium that you are writing. It's also linked to the growth that you experience, the growth in written premiums. It's also linked to the asset under management if you are writing more investment linked business, and it's also linked to the size of your liabilities. But it's one of those risks that are very difficult to quantify and measure. And the thinking in terms of linking it to premium or liabilities is that you expect errors, system failures, if maybe you are doing a lot of transactions, or depending on the size of your business, so you expect more operational risk. I spoke earlier about economic capital, where insurers feels that what NIC maybe have allowed for operational risk is not enough. Insurers on their own can go and say, from our point of view, I don't think the capital that we're holding for insurance operational risk is enough. We believe we need to go higher, and that becomes your economic capital. Thanks, Richard.
Okay, thank you very much. Yeah. Maybe this question should go to the NIC, but I will direct it to Kofi because you are in the should there be changes to asset admissibility rules, Kofi? Someone is asking.
Okay. So if, and Kwabena, correct me if I'm wrong, all assets, do they mean the various whether it's ultimate or tier 1 and tier 2? for risk-based capital, or it's most because currently there's more assets are charged based on the type of assets that it is. So currently the solvency, if you have cash or near cash, so T-bills and all that is charged at, I believe, 5%. And this has been in operation for a while, and I think those charges would be rolled back when the RBC is implemented. And I believe that for year 1 and year 2 subsequent years, there might be the capital charges on whether it's in investment returns or any of those that are capital charges that are stipulated in the RBC would be reviewed. I think one key thing that we had a challenge with when we were I was part of the committee that industry committee that helped with some of the review of the RBC before it came out. And one key thing that we pointed out was the charges on mortality. If you compare it to other countries, we felt it was slightly high. The NIC assured us that once they put in a process and we go through year 1, year 2, they would have a review of those charges. And so I'm working in this with utmost good faith that once they check the impact, they would realign some of the capital charges if they see that it's too onerous or it's too lax.
All right. So, any remarks on that one?
Agreed with the monitoring. I think just as I said, and we need the support from the industry to be able to do that monitoring. So you asked earlier on whether we will be putting this across. So to be able to effectively monitor some of these risk charges and be able to say, right, let us drop that risk charge. I agree. I agree with that.
Thank you. Ben, did anyone raise their hand so that we allow the person to talk? I have 2 more questions I'm going to read out, and then I think after that, we will bring the session to an end. But if anyone has raised their hand, please let me know. So first question is, what are some of the shortcomings of the current risk-based solvency that RBC is seeking to address? Takalani, I'll let you take that one.
Yeah, thanks, Richard. I thought this question was going to be best answered by Kwabena, but I think at the beginning, Kwabena indicated that our current regime, although it's more of a volume-based measure, and the new RBC regime, it aligns with global standards. It aligns with what is happening in Kenya. It aligns with what is happening in Europe. It aligns with what is happening elsewhere, and also it's the underlying liabilities. They aligns with what we did on IFRS 17. So there's a closer alignment with global frameworks, and that sort of like from a confidence point of view, from an investor attractiveness point of view, that is great, and also a lot of companies that are operating throughout Africa. They are not operating only in Ghana, but they operate elsewhere. You have companies that operate in Nigeria. You have companies that operate throughout the continent. So for investors who are comparing the capitals of various companies, if they are calculated in a similar framework, it becomes easier to compare. But I will invite maybe Kwabena to come in from a NIC point of view.
Kwabena.
Yeah. If I was to use a phrase to answer that question, I would say risk consciousness.
Yeah.
Insurance business is not just taking premiums. It's also understanding that there is a link between the risk you undertake and the premiums you collect. And risk-based, and that's why the name is risk-based capital. Is to bring us in that alignment, so that we would be thinking of the risk that we're undertaking effectively enough to price it and capitally put some capital down that is adequate. The protection of policyholders is very important for us, and limiting some struggles we see with companies. I think that effective management of risk will lead to early warnings of um, companies dropping off, so that it's not just about, oh, the company has collected this much premium, but we don't know the risk underlying could be vast, way more, but the company is collecting and so when issues begin to emerge, because we only thought about the premium and not the risk, it begins to be very clear that it wasn't very well managed. So, from our point of view, supervision of the insurance market is very key to alleviate these, rather, if you want, coming at these deficiencies late, having early warnings to be able to regulate the market efficiently. Now, what does that do? That breeds confidence. Takalani mentioned we are aligned with global standards, but this also breeds confidence, so that if investors are looking for returns in various different markets, and really was able to, they'll have the analysts look at data across different jurisdictions, they're able to relate to the market and be able to tell what sort of returns they can get in here. And emerging markets are much more attractive to investors these days. So that confidence, if we can give that confidence to investors, we'll begin to see investors come in and growth. Currently, it's quite difficult to attract capital into the market, except for the market domestically or locally. So you only have, like, it's quite difficult to attract many a foreign market. Or we see South Africa, South African investors come in, but actually having investors from various different parts of the world. The attraction really is not there, because the clarity of risk or the clarity of the supervision of the market is not. So this seeks to grow the market also in that light. There's a lot of benefits with it. I'll just mention a few.
Thank you. Thank you. I'm mindful of time. So, two statements, but I'll put them to you. Like the lawyers will say, someone says the industry just came out from IFRS 17 implementation, which was a huge cost. Now we are pushing them to also comply with RBC. They are saying that please go and revise your levies on them. So consider that one. And then I know that you would issue some public information when it comes to disclosures on their solvency and stuff. Is that going to happen?
Sorry, when you say public information on disclosures?
No, someone is asking around public disclosure requirements on solvency ratios. Are you going to issue something like that?
Right. Okay. Yes, the metrics. Yeah. That will be following.
Okay,
Yes.
thank you so much, everyone. I think we have addressed almost all questions in the chat box, and we want to thank you so much for making time to join us wherever you were. We appreciate you. Please, if you have any other question, our time is up. You are welcome to send them to us, email them. Those, if you have my email address, you are welcome to send it to Dr. Situ or myself, or even the link that the mail that sent you, the link, you can share it there. We will compile all of them and then give to the panelists, and then they will answer, and then we will share same to you. We want to appreciate each and every one for joining. Dr. Situ, any comments? But I don't know before then, if Takalani, you can give me your final words. Kwabena, final word, 30 seconds each. Kofi, final words, 30 seconds each, please. Oh boy.
I think from what Kwabena has said and the timelines, I think that we as industry, we need to start getting the arrangement and start getting the stuff done today after this call, so that we will be able to meet the deadlines. And also keep an eye on the actuarial department and then try to build actuarial resources internally. Thank you.
Thank you. Takalani?
Yeah, thanks, Richard. I think it's exciting time for Ghana, exciting time for Africa. I think it's in the RBC framework is coming in the right time, just after implementing IFRS 17. There's a lot of changes that IFRS 17 brought that we can leverage. So looking forward to the future. Thanks, Richard, and thanks everyone for attending.
Okay, Kwabena, from your side.
Yeah, thank you also for inviting. I'd say the NIC is not here to penalize, but to actually grow with everyone else. So know that we are in this together. The building of the capacity is required on the market as much as we are also building. So I want to just use the word, we're growing in compliance together. Yeah.
Thank you so much. Dr. Situ, if you are here.
Yes, I think my last words are on the screen. So it's very obvious. So please don't wait. We've seen that attitude when it was the IFRS 17 era. Don't wait. It is time to act, and act now. Let us engage. Let us help you in a gap analysis. Let us help you to translate your 2025 by June 2026. Okay, let us help you in model development, model documentation, risk management policies. Let us help you with data quality. Let us help you with system integration. So these are things and many more that we can help you do when it comes to risk-based capital. So please engage. And when you see me knocking at your door, it's obvious. I'm not coming in the name of IFRS 17, although we are still on, but this time around, my voice is risk-based capital. Let us grow together. Let us help you get to where you need to get to. Thank you very, very much. And you can't take away the cost, because you have found yourself in a compliance environment, right? Once you are dealing with public funds, compliance is key, and you cannot run away from the cost. So thank you very much, and we'll see you again in your office.
Thank you, Dr. Kwabena Situ. Thanks, my panelist, Kwabena, Head of Actuary, Kofi, President, ASG, Takalani, and Charlotte. We really appreciate you joining us on this webinar. Thanks, everyone, and let us grow in compliance. We'll see you again. Bye for now.
Auditor talks relationships, getting to know you, earning your trust. All good things. But what if an auditor went deeper and thoughtfully designed a risk-based approach to audit based on their understanding of other relationships too? Like the relationship between your technology priorities and capital investments, between inventory on hand and your growth strategy, your move toward automation and the impact on your workforce, your strategic priorities and plans for succession. Understand those types of relationships, and the tangible value of an audit can go beyond compliance. That's how we approach audit at Deloitte Private. Our approach is honed on a global stage and tailored to your business with private company perspective. Our audit is informed by AI-fueled insights and data analytics. Our processes and cloud-based tools reduce the burden on your team. And our people are big-picture thinkers, skilled at connecting what they find with the potential risks and opportunities you face. Relationships are important. Our risk-based audit is rooted in understanding your business and designed to provide valuable insights on what matters to you. Audit and assurance services from Deloitte Private.